Hey folks, this is Sean Hyman from The Logical Investor, and I wanted to talk to you about entry points and averaging down, particularly the averaging down piece, because sometimes people say, when should I average down on XYZ, whatever it is, whatever stock. And so I'm going to teach you this principle using just the general S&P 500 index. Before entering a stock, of course, a stock or an index, you need to make sure that the asset is solid, which with broad-based major index of large companies is basically by default solid. And then the second thing is you need to see if it's at a good price or not. And there's two things that can tell us if something is at a risky price or not. One is how far the price of the asset, which in this case the index, is away from its 200-week moving average. As you can see, when the price gets a distance away from that, the risks are high, and the chances of it dropping down towards that average are very probable. So your downside risks are great in those times. So you don't really want to buy something far away from its moving 200-week moving average, even if it is a solid asset. And of course, right now the market is overvalued, and that's the other way that we know whether we should even be buying something or not. This is a site called multiple.com. multpl.com, multpl.com, and it shows the average price to earnings ratio of the S&P 500, and right now we're at 25.70, which is at the historic high end of what the price of an index gets relative to the average earnings on the S&P 500 before there's a crash. These two spikes up here are just simply where the earnings crashed so hard, so fast relative to the price that even though the price of the index was crashing as well, these gave kind of erroneous readings because it was two times where the U.S. or global economy, almost was at such a danger, it almost collapsed, and without serious intervention from the Fed, the Treasury, etc., it could have been very, very ugly. So. We're basically at crash valuations right now, and so this is you may be viewing this video at a time when it's not like that. So just keep in mind, I am, some things I'm talking about are timely, but overall, what I'm going to teach you today is a timeless principle, no matter where no matter when in time you're viewing this video. So we know the market is expensive, so we would want to take that into account when we go back to our S&P 500 chart, because we know that just a simple pullback to this moving average isn't going to take it from crash level valuations to a value. So it's going to take something deeper than that. Also, we know when we have bear markets, which happen after 5 waves up uptrends, 1, 2, 3, 4, 5. So when you have bear markets, that's what these are. You have large ABC downtrends. A, B, C here. Here's A, B, C here. 3-wave downtrends that can tend to be long. This had the S&P 500 index go from 1576 to 666. This one from 1553 to 768. So we're talking about some major moves that can happen. Also notice in downtrends, the price goes way below the 200-week moving average. So that's another observation. So because the PE is so high and because the price in a bear market goes way below the 200-week moving average, it tells me I don't even really need to start looking for support levels on the chart to start averaging or buying in. Because right now, honestly, when you're towards the end of wave 5s and the price is so far historically away from the 200-week moving average, I would have little to no exposure to the S&P 500. That's just me. So I wouldn't be looking to average in. I'd be looking for re-entry points from a position of being in cash. And really, there is no reason at all to get back into the S&P 500 until it falls to somewhere along these support levels. Now, how do I come by these levels? So I look at a very long-term chart, many times 20 years back, sometimes only 10 years back, but when I'm expecting a bear market, I look 20 years back. When we're earlier on in and a trend's move, 10 years back is sufficient. All right, so how do you do that? So let me see if I can find it here. There we go. So at stockcharts.com, when you bring up their free charts, I select the weekly, and then on the range, you can select up to 5 years, or you can select start and end period. And so that's what I do. So I click on the start and end period, and then since I'm recording this in 2018, if I want to go back 20 years, I'll go to 1998. If I want to just go back 10 years, I'll tell it to go back to 2008. And then I click update, and that will give me my chart. So that's how you can create a free long-term chart using stockcharts.com. So and then of course I just went into Microsoft Paint, which a lot of Windows PCs have, and I drew zones, support zones, because remember, support and resistance zones, they are truly zones or areas or regions. They're not an exact line. So that's why I tend to use square boxes to kind of emphasize that zone. So you can tell in the past, for instance, there was a lot of trading that went on in here. So the longer something trades in an area, the stronger that area of support could be. So in the past, the S&P 500 had a sticking point right about here, and it wanted to head higher. So you project that out into the future, and that tells you around the 18 to 1900 area is one of those areas. Then below that, what do you have? Well, below that, you have what used to be previous resistance areas in the mid to high 1500s, which were the two last market tops. So the rule in technical analysis is previous support tends to act as previous resistance, which is where this topped out, hits a ceiling, tends to turn into future support. So I project that into the future by drawing this box over to here, and that gets me to the 15 to 1600 area, which is also well below the 200. Both of these are well below the 200-week moving average. So really, they would only be the first points to start considering averaging down. And then, of course, if we weren't in such an overbought, overvalued market, just your 200-week moving average would be one kind of moving support that would generally be a point of consideration, which is this red line, the 200-week moving simple moving average. But since it's so overvalued, and since we're due for a bear market, which goes well below that moving average, then we don't want to consider that one at this particular time. But if we were earlier on in this trend, you can see where the 200-week moving average was great here, it was great here, etc. But at the tail end, the 200-week moving average doesn't eternally hold. So once that 5-wave uptrend has unfolded, then it's time for a 3-wave downtrend, which is like what you'd had here, and they go well below their 200-week moving averages. So this is why here or here would be really some of your starting points to buy back into the S&P 500 index. Should it drop below this, then you look for future areas of support. Well, there was quite a bit of consolidation that happened right in here, where the market spent quite a bit of time in here for a couple of years. So where was it stopping and sticking points here? So it was right in this box. So I've projected this box out into the future. So that's about the 1000 to 1100 level. And then finally, where the previous crashes stopped in their totality was in the 700s to 666 area. Horrible number there, huh? So I drew a box here as well for a final support. Now normally I suggest you dividing your investable money per stock or index into groups of 3. However, when you are at historic levels of overvaluation and historic levels where the price is so far away from the 200-week moving average, you might actually consider a fourth, dividing your money into fourths and do it that way. That way it takes a lot of the guesswork out of where to start. So in other words, you let the market get some of the fluff out of it, and by the time it makes it past its 200-week moving average, the market is turning very, very bearish. A lot of algorithmic trading systems are in sell mode and sell short mode, and sentiment is so horrible that it helps it to go down to this region typically very quickly, very easily. And remember, you want it to go fairly, a distance below the 200-week moving average before you ever start anyway, because bear markets don't end anywhere near their 200-week moving average typically. So this first level of support here then makes sense for the first entry into the S&P 500, because we don't know if this will go all the way back to previous crash levels. Maybe it does, maybe it doesn't. And I'll address that for you here in a minute as well. So we start here. Here's your first round that you put in somewhere in the 18 to 1900 level. So when the S&P 500 is to that level, that's when you put a fourth of your money, in your 401k back from cash to there. And this is just a suggestion. This is not one-on-one advice. So obviously you've got to decide if this makes sense for you, but this is what makes sense for me. And then the second round would come in around the 1600 level, which is where there was previous resistance that goes to previous future support. Then if the market should fall further, the next place you'd go is in the 1100 area. And then the fourth one would be at the end of the previous crash. Now, keep in mind, that doesn't mean that just because the market stopped here and here, that it has to stop here and that'd be the ultimate low this time around. But what this averaging technique does is it gets you much further down than you ever would, if you just went all in with your money. Also, the chances of us going from 2872 to 600 are not all that great, because we went from 1500s to 6 and 700s last time. So we're probably not going to go from 2800s to 6 or 700s this time. But you've got some money reserved there for if it should. So we're probably going to see, these three be sufficient, but you'd have some money left over in case it dropped further to further lower your average break-even point. So if it does that, and you've used equal dollar weighted amounts each time, and you did get 4 invested, then your average break-even point is somewhere between 2 and 3, and which is a much better average break-even point than if you'd have just had the market drop back to here and went all in. Big difference between 1800 and 2200 and say 12 or 1300. If you only got a few of the averagings and your average is at 14 or 1500 or whatever, then that's still far greater as well. Okay, so let's say that you get 3 averagings done and the 4th averaging never happens because the market never dips that far. So how would you know when to put that money back to work? Here's how. So in downtrends, you can pop a downtrend line across, and you can eyeball these, or you can draw them with something like I use, like Microsoft Paint. So you can draw downtrend lines connecting the major high points, and seeing when those happen. And of course, this one got so steep. I mean, you could even be a little more aggressive and get the steeper area. This is little art, not quite as much of a science. But when the C wave, and this is C wave here, and this is C wave here. When the C wave, which is the third wave, A, B, C, breaks its downtrend, then you could put in your final round there, and there's a good shot that you are fairly safe there. It doesn't mean that it won't pull back some more. Obviously, it can, but it's one of the better places to go ahead and put in a final uninvested round when you know that the likelihood of the downtrend being broken has already happened. So in here, that would have been right here, where you could put in a final round if for some reason all your rounds hadn't been invested. And same thing, I would go here rather than here. Here's the most conservative trend line, but at the line that follows wave C, which is one of your longer or stronger waves, when that was broken, I think that's sufficient to do it as well. Another thing that you can do if you question yourself on how to draw trend lines is when the price of the index comes back above the 50-week moving average, which you see happen here. This blue line is the 50-week moving average. and right in here, the 50-week moving average as well. So those are other ways that you can tell that it's probably a safer time to get back in. Doesn't mean that the market can't pull back some more from there before totally heading higher, but you're dealing with probabilities because nobody knows exactly how deep a downtrend goes. Nobody knows when the extreme pessimism will finally end and the buyers take back control, etc. I assure you, nobody in this downtrend would have thought that the S&P 500 would have lost almost 1,000 points from 1576. I assure you, they wouldn't have thought that it would have lost, that much. And same for this one as well. So crazier things can happen. So I know it seems like these are levels that are far down here from up here. And at the time when you're towards the top of an uptrend, it doesn't seem like it's even possible for the market to go back to those areas. But keep in mind, the market went from 768 to 1576 over a period of years, and it just seemed like the bull market would never end. And then this bear market happened. And the same thing, in the 90s, which I don't have all of its trend here, but in the 90s leading up to 2000, on its way up to 1553, it had a huge similar move like this. And, everything was so bullish, the news was so bullish, everything was so positive when you flip on the news media that it just seemed like this would never happen. But overvalued markets always have to correct and come back down to reality. And they don't just go from overvalued to fair valued because human emotion is so intense at those moments, it's not going to stop it at fair value. So human emotion, which is what drives these markets, especially at extreme points, is going to drive the market from a state of overvaluation, which we're at now, to a state of undervaluation. So it means it's not going to go from a PE of 25 to a PE of 15 or 18, most likely. It's probably going to go from a PE of 25 down to something like and I'm guessing, but PE of 6 or 8 or 10. So that's going to bring the market, way down in due time in that bear market. And so I would suggest, in this particular instance, dividing your money into fours and going in at these different levels. And if for some reason it never gets this bad, to where you never get your last round or two invested, then either when the most aggressive trend line breaks or when it comes above the 50-week moving average, with the 50-week moving average is going to be the easiest for most people to realize. So just in the SMA, which is the simple moving average area of your chart, which is right here in your overlays, simple moving average is what you would choose right there. And you've got 50 and 200 are your periods. And when you're on the weekly time frame, there are a 50-week moving average and a 200-week moving average, simple moving average. And when you're had it been on a daily time frame, which we're not discussing right now, there would be a 50-day and 200-day simple moving average. So you can use this principle with any asset. Now, when you're dealing with an individual stock, remember, go to somewhere where you can see the fundamentals, or just follow me here at this site. And the stocks that I pick will already be pre-screened for these types of parameters. But yeah, a site like Yahoo Finance, finance.yahoo.com, will help you to tell if a company is sound financially. For me, something sound financially, it has to have multi-billion-dollar market cap generally. It has to have a multi-billion dollars in earnings that it earns per year, which will be in the EBITDA section, EBITDA. And it has to have billions in cash on its books, and it has to have low debt relative to its market cap, which is 50% or lower of its market cap in debt, or ideally 33% or lower in debt. So I know that's a mouthful. That's a lot. So that's why I have my newsletter service, so that you never have to figure out any of that type of stuff at the Logical Investor. So which is at SeanHyman.com in the premium tab, if you're not having to watch this on my site. So you go to SeanHyman.com, click on the premium tab, click on any article or video in that premium tab, scroll to the bottom, you'll see a sign up box, and you can become a member and subscriber. And then all newsletters and videos and recommendations will all be at that premium tab. The latest newsletter and video will be up at the top of the page. So anyway, so you would want to make sure that the asset is solid and that the asset is cheap fundamentally, first and foremostly, which means a cheap PE, price to earnings ratio, and you can find all that at Yahoo Finance. And then if those two criteria are met, then you would want to see where long-term support levels are for averaging down in stock, in your stocks. But that's the way that I gauge how to average down is twofold. One, where are the major support levels on very long-term charts? And two, those averaging down points need to be far enough percentage-wise to make sense to bring my average break-even point down enough. So if we were dealing with an individual stock and the stock dropped from 50 to 45, that's not enough of a drop for me to do a second round of investment, because my average break-even point now just went from like 50 to 47. Okay, big deal. That's not a big enough difference. But let's say if the stock dropped from 50 to 35 and my break-even point is now in between those two, that now is percentage-wise drop enough in my break-even price to make it worth putting additional capital in the market at risk. So that's the main thought. Is it worth putting the capital at risk? And the answer is yes, if the asset is solid, cheap PE, and the percentage pullback for your average break-even price would be enough to make it feasible. And finally, if it coincides with some major support or previous resistance zone on a 10 or 20 year long chart. So, and for those who are subscribers to my newsletters, over the last pick or two, which is at the time, obviously, of the filming of this video, because some people will be watching this way later than that, I have some suggested averaging down points on a couple of our newest picks, actually inside those newsletters as well. So that kind of makes that easier for subscribers also. It's something I'm going to start implementing more. Okay, thanks so much for watching, and God bless. Bye-bye.